All right, hello, welcome traders. Hey, today I'm going to do something a little bit different, and we're going to do a little comparison of the income poor man covered call versus real estate investing. And been meaning to do something on this for a while, and I've had this training sitting around, so I wanted to update it for you. But while growing up, I want to say that everybody has said, hey, put your money into real estate. You want to own a house. You want to, own something and you want to create value, you want to rent it out, and you're going to make all kinds of money, and those renters are going to pay off all of your mortgage and your expenses for you, and in the end, you're going to be owning real estate, and then you can just keep multiplying it, and all that is great. And I'm not here to poo-poo real estate investing. What I am here to do, though, is tell you I think there's a better way. Okay. I think there's a better way to make money, accumulate wealth over time. And to me, it's the income poor man covered call. And so let's get into it. And I think maybe you'll find some pretty interesting comparisons here as we go through. So let's jump into it. So why are selling at the money covered calls with the income PMCC? Why it's better than real estate investing. And let's get into it. So the income poor man covered call strategy, as I like the IPMCC, if you can say that, that I like to use, okay, which is a little different than the standard poor man's covered call. To me, it's just a capital efficient way of selling covered calls. Okay, instead of paying all the money for the stock, I'm paying a third of that for the leap. So how do we do this? Well, we buy a long dated leap, typically deep in the money, 12 to 24 months out, around 75 to 85 delta or so. I really like that 80 delta. I think that makes the most sense. And then I'm selling either weekly or monthly at the money or even in the money covered calls against it. And my goal here is to maximize the extrinsic value or the premium income that I'm getting from those covered calls. All right, pretty self-explanatory so far. Don't think anyone's arguing too much about this, except for some of you, you're going to struggle with the word at the money and in the money. I get it. Half of you don't get this. I'll get all kinds of people posting, oh, but you're going to get killed when it goes up and you don't know what you're doing. And it's all good. You don't have to understand it. If you can't comprehend it, okay, watch it a couple times and really start to think about it. Do your own reviews and work, and you're going to see how this is a better mousetrap than the standard poor man covered call. Okay, I'm shooting for the extrinsic value, not the capital appreciation. Totally different. Okay, same thing as if you were in real estate. If you only wanted capital appreciation and you didn't care about your income, you would charge less rent because all you want to do is sit there and wait for that house to increase in value. Well, a house goes maybe what 2 to 3% in value a year or something like that. So if you're not generating enough money from that, you're not gonna get rich and wealthy over time at 2% a year on your real estate holdings. Okay? You've got to generate that income to pay things down. Well, for me, I want to generate maximum rental income here, okay, and not just small out of the money income. And I'm hoping for this capital appreciation of my house. Okay, you're not getting rich on the capital appreciation. Okay, you're going to make money and generate income from the rent, which can then pay down your basis, which then will increase your wealth. However, we're going to do the at the money and in the money calls. And at the money calls provide maximum time premium, the extrinsic value, because they're closest to the strike price and they have the most uncertainty about ending in the money. Okay. So you're going to get paid a little bit more from it. In the money calls also provide increased protection versus the pullback. Okay. So you've got at the money, which is your maximum amount of extrinsic you're going to get. If you're out of the money, your extrinsic is lower, but you're hoping maybe I'll get some price appreciation if the stock goes up. In the money, it's the exact same amount of extrinsic as you're out of the money, except you're adding protection. So the question is, do you want to make that extrinsic value and get protection, or do you want to get the appreciation? I'm going to argue that getting the extrinsic is more important and that protection than the out of the money here. of which there's no right and wrong here, just a different way of doing it. So in the money, out of the money, and at the money here. Premium income, at the money, high. Out of the money, moderate income. In the money, moderate income. It's the exact same income in the money or out of the money, except you're getting paid more in the money. So if it does drop, you could see monstrous premium income if you're doing this when the stock is dipping a bit. And then you can go back to at the money when the stock is more neutral. All right. Probability of assignment, well, at the money, it's a little bit higher than out of the money. And in the money is going to be higher than out of the money as well. None of them are highly probable unless your extrinsic is almost gone. Okay? Only dummies want to own something where they have to pay a lot of extrinsic for it. Wait till the extrinsic comes out and then buy the call, okay? Or take it away from somebody. All right, total ROI at the money, it's higher. Out of the money, it's lower, and so is in the money, it's a little bit lower ROI, unless the stock is neutral to dipping, in which case the in the money is going to generate even more ROI. Neutral to slightly bullish strategy. The at the money is a neutral to slightly bullish. Out of the money, it's better for bullish. It's not great for neutral because you're not generating enough. Okay, and the in the money also works great with neutral to slightly bullish, but it also gives you bearish protection. So you kind of get the best of all worlds. If it's neutral, you make the extrinsic. If it's bullish, you still make the extrinsic. And if it's bearish, you get additional protection, which you don't get at the money or out of the money. So it gives you more opportunities here. And then what's your goal? Well, goal of at the money is just income generation. I want to generate as much income as I can. Out of the money, I want to get a little bit of money, but really just I want that potential upside appreciation. Okay. You want your house to increase in value. Okay. In the money, I'm going to get income generation plus protection in case the housing market starts to fall or the stock starts to fall. I get paid to be safer and I still get my income. All right, good example here is Amazon. So right now Amazon's trading around 212 bucks. You can buy the leap on Amazon if we go out to January 2027 and I do the 155 call, it's about $73. Okay. So instead of spending 21,200 on 100 shares, which is 212 times 100, I'm spending 73 for one contract, which is 100 shares, and 7,300. So I'm actually paying 1/3 the price to own the leap. Why own the stock? Okay, when you can have the leap for 1/3 the price and get essentially the same price movement up or down. I don't like stocks for this very reason. I prefer leaps where I can actually buy more or at least the same quantity and use a lot less of my capital. All right, and then I'm going to sell a weekly Amazon 210, which is at the money or slightly in the money. So in this case, it's going to be $2 in the money. But if I can get $3.70 and it's $2 in the money, 170 cents or $1.70 of that is extrinsic value. Okay, so I'm getting $1.70 of extrinsic. Well, if you take the $1.70 of extrinsic divided by the $73 you paid for the leap, you're going to make 2.3% on the extrinsic premium weekly. And you're also getting $2 of downside protection versus just getting 0.5 to 1% for maybe going $5 out of the money and selling your covered call around 25-ish delta or something like that. So, would you rather 2 to 3% ROI a week, or would you rather 0.5 to 1% a week? And the 2.3% ROI is also giving you downside protection that if you drop $2, you're actually going to make $2 additional on the premium, which is going to offset your losses, okay, or at least a portion of them, okay, which is fantastic to me. And let's say we take that 2.3% a week, that's 119.6% annualized ROI on just the extrinsic alone. plus any appreciation of the leap or the cost to roll in the money. That's if it goes up. If it actually goes down, you actually make more money because you're selling in the money, you're getting additional premium, which is offsetting losses. So however you want to do it, whether that thing goes up or down doesn't really matter because no matter what, you'll make 120% on your extrinsic. That sounds pretty good to me. All right. And then we don't even have to worry about what the underlying is doing. All right. So real quick, real estate investing, using a traditional approach here for you is you've got to find and buy the property. I mean, finding real estate to rent is a pain, and then you got to fix it up. Okay. Then you got to find the tenants and rent it out and advertise it. And then you've got to manage all the repairs, pay property taxes, pay insurance, okay, and then also handle any potential vacancies if you can't find renters. Okay. Not to mention all of the costs it takes to fix it up to begin with, which is not normal maintenance repairs. It's putting money into it to fix it up. Okay. And then the holding costs of still having to pay the mortgage without income. There's a lot of problems with real estate investing. While the results can be great, okay, you can make way more money on the poor man covered call. All right. So typical numbers here might be, let's say we want to buy a house for 400,000. I'm going to need to put 20% down, so I'm going to need to come up with $80,000. In my example on Amazon above, I needed $7,300. Okay, we'll even put that in here that it's only 7,300 for one contract. Okay, big difference between 80 grand and 7,300. Imagine if you had the 400,000 or the 80 grand to begin with. Okay, you could buy 10 contracts of this. Okay, and you could be making 10. Okay, instead of making 170 a month, okay, you could be making 1,700 a month of extrinsic, okay, which might be better than what you're clearing on your rent because here you've got a $2,200 mortgage, a $2,700 rent that you're charging. You're going to make maybe $500 a month. Okay, well, $500 a month isn't bad, and you've got that potential $3 or 3% a month of growth, but really on your money, you're talking like 6 to 8% a year on real estate. Okay. Maybe you get a little bit more on your appreciation. Okay. But you're not getting 3% appreciation. You're getting about 3% a year of appreciation. So maybe you can get this up to 9 to 11% a year when you factor all of that in. Seems like a lot of work and very expensive, ties up your capital. All right, so a couple quick numbers side by side here. For the poor man covered call, I need about $5,000 to $20,000 to get started. For real estate here, I'm going to need about $80,000 for the example I just went through. I can take cash flow weekly or monthly on the poor man covered call, and in real estate, I still get it weekly. My annualized ROI can be anywhere from 30% up to well over 100% selling at the money covered calls. Okay. Real estate, I might make 6 to 8% a year. And if I throw in 3% of capital appreciation, maybe I can get that up to 10% a year, okay, versus 100%. Okay. Liquidity, too, I can close my positions down anytime I want to. So if I need the money to do something, I can close it down tomorrow. Real estate, I got to put it up for sale. Okay. And if I want a certain amount, it could take a while. The real estate market might be hot where you are, so maybe it only takes a couple of days, but then it takes a month to get your money out and money back and all of those things. Okay. So, and that's if you find the right buyer that can get that money to you quickly. Okay. And then a couple more things. Taxes, I get 60/40 long-term capital gains. Okay. So on the long-term poor man covered call, if I own that for 2 years, I have a 60/40 short-term, long-term, short-term capital gains. Very beneficial. Taxes on the real estate side, well, I got property taxes and I have capital gains I have to pay if I sell the property. Risks. Well, the risks are defined by your LEAP value. You have a risk of the market selling off, the stock falling. Those are definite risks. Okay, so this is not risk-free. However, if you can make through the extrinsic your money back in 14 weeks or so, okay, or something along those lines. Now, in the example we gave, if I spend $73 to buy the leap and I can make $1.70 extrinsic every week, okay, 73 divided by the $1.70 I make every week is 42 weeks. So in 42 weeks, I actually own the property completely here, the Amazon Leap. Okay. So after that, I don't even have to worry about uh, risk. Okay. I now own it outright, and there I have no risk in the trade, and everything from then is pure income. Okay. Because you have no basis anymore. All right. And then maintenance required. I have no maintenance in a poor man covered call, but I have a good amount of maintenance, especially if you have renters that aren't great. Okay. Diversification, pretty high. I have multiple tickers. I can use SPY and QQQ, and I don't have to worry about individual stock risk. I have market risk, but not stock risk. Okay. And I can handle multiple tickers, ETFs, you name it. I can go any direction. I do it in gold as well. So I've got gold and stocks and ETFs and indexes versus in property taxes or in properties here, real estate, it's low diversification. I'm stuck in an area. Okay. Most people are in their general area, so you're not really diversified. If the market gets hit in your town, okay, all of your properties are going down. Okay. So you get a little bit more diversification with the poor man covered call. And then leverage. Okay. Leverage is built in using options. I have good leverage. Okay. The leverage here in owning a house or buying a house and renting it is it's external via a mortgage. Okay. I'm leveraging it because I'm having to borrow money from someone else instead of having leverage that's built in using options. Lastly, here, volatility. The volatility is medium with leaps. If you're buying good quality stocks, not these crazy meme and high flyers, good quality stocks, okay, your volatility is medium. In real estate, your volatility is low. It's typically a slower moving market. Okay, your volatility is not, you're not going to fluctuate as much, so there is some benefit there to you. All right, a couple of last things here. For me, risk management and scaling. Well, poor man covered call risk controls. Number one, have a stop loss on the leap. I will stop around 30% if the price drops. Okay. I could also roll the calls up or down weekly if the trade is going against me. I can, if it's going in my favor, I can actually roll for more credit the same week. Okay. I can also reinvest my income into new leaps, and I can diversify across more tickers because I'm generating more cash flow at 30, 50, 100% a year of cash flow versus 6 to 8%. I'm going to have more money quicker to scale and compound and reinvest that income into new leaps. One of my favorite tactics is when I make enough money selling the extrinsic to equal buying a new contract or leap, I'll do that. So I'm actually letting my income buy continuous new long leaps for me. In real estate, it's going to take you a while to get any of that equity out enough to use it to buy another property or that income out at only 6% a year. Right. And then real estate risks, you do have tenant defaults. You have property damage that can occur. You've got, I didn't even put in here, major maintenance things. What if the roof, goes? What if a tree falls on the house? Okay, you've got insurance potentially. Maybe there's some out of pocket though, which is property damage. But something leaks, something goes awry, people damage things, the market goes south in real estate, or it can be a liquidity trap for you as well because you just can't sell fast and get your money out if you want to take advantage of something else that's out there. So when would you use the poor man covered call versus real estate? So again, for me, it's My goal is to consistent weekly income. That's what I want to generate is consistent weekly income. Or if you want capital efficiency, I want to make more money on the capital, and I don't want to put all of my eggs in one big basket right now. I want to diversify. Okay. Or if you prefer no maintenance and dealing with tenants, I can't stand doing that. So I don't want to do the maintenance. I don't want to hire people and pay people to do the maintenance. I don't want to deal with people. I trust myself and I just want to invest with myself. Okay. If you want faster compounding, well, 30, 50, 100% a year, it's going to compound a whole lot faster than 6% a year or 10% a year in real estate. And then again, if you need liquidity or flexibility, okay, I think these all show really that the poor man covered call, especially the income poor man covered call as I trade it at the money or in the money, I think it's a no-brainer. I think it beats real estate hands down. It allows you to scale. I think you're going to be better off. Something to take a look at. Do what's right for you. Not saying go sell all your rental properties tomorrow. Okay. Certainly think there's value in doing that. But if you want to make more money quicker, okay, I think scaling up your poor man covered call portfolio will pay off way more than owning property. Take care. Hope this was valuable to you. If you like this, give me the likes, the thumbs up, the likes down below, and we'll get the word out to people. If you want to join us in the Discord and see what we're doing, how we're trading these things, what the new trades are. We go live and trading several times a week here. We post all the trades if you want, and we help you with your trade plan. If you want to get better, join a group, join a community, get better at what you do. We'll see you later. Take care. Bye-bye.